Good morning, everyone, and welcome back to the Daily Hunt for Multi-Baggers. It's Thursday, November 20th, 2025, and we've got a busy show for you, digging into all the market chatter and data collected yesterday, November 19th.
That's right, Ethan. Yesterday was quite active. We saw a massive surge in discussions, flagging many different stocks. Some serious bullish momentum, especially around AI plays, but also some deeply bearish sentiment for others. The market is definitely serving up a mixed bag.
Absolutely. Let's jump right into it, starting with Oracle, ORCL. The buzz around Oracle was, well, pretty negative, focusing on that huge $300 billion OpenAI deal. There was a lot of talk about how Oracle's stock has already crashed since the initial hype. This stock was rated stay away back on October 8th.
And for good reason, Ethan. The data shows Oracle's debt-to-equity ratio at an alarming 452.5. Users are right to be skeptical, questioning how OpenAI, with its current revenue, can possibly meet a $60 billion annual payment to Oracle. That deal structure is just unsustainable and looks like a huge financial risk. The current price is also way down from its 52-week high, clearly reflecting a loss of confidence.
So the previous stay-away rating holds firm today.
Definitely. Our verdict for Oracle ORCL remains stay away. The debt and the deal viability are major red flags.
Moving on, let's talk about NVIDIA, NVDA. Wow, the chatter was just absolutely buzzing with excitement after their Q3 earnings beat. People were calling it a double beat, praising the 73% gross margin and how Blackwell sales are off the charts. We've given NVDA a mix of ratings in the past, from stay away to cautious buy and buy. Our last rating was actually stay away on November 15th, so this would be a significant shift.
Now hold on, Ethan. While the user sentiment is overwhelmingly bullish, and yes, their revenue growth at 55.6% and net profit margin at 52.4% are truly exceptional, we have to look at the full picture. The PE ratio is still high at 53.14. And, more critically, the debt-to-equity ratio is listed at 10.584. That's unusually high and, if accurate, represents a substantial financial leverage that the community doesn't seem to be acknowledging amidst all the hype. It's a huge divergence from what we'd expect from such a profitable company.
I hear you, Brooke, but the overall news cycle and the sheer demand for their AI chips, even with the new U.S. government approval for Middle East sales, points to continued strength.
Anticipation is one thing, but those KPIs demand caution. My verdict for NVDA, despite the strong buzz, is to approach as a cautious buy. The DE ratio, even if potentially anomalous in our data, means investors should tread carefully.
Next up, Microsoft, MSFT. The sentiment here was surprisingly bullish given some general market anxieties. One user even stated, "Have some conviction on MSFT. We'll continue to buy more contracts." We've rated MSFT as a buy or cautious buy previously, most recently cautious buy on November 7th.
Well, fundamentally, MSF looks solid. Revenue growth at 18.4% and a net profit margin of 35.7% are very healthy. And their debt-to-equity ratio is a very manageable 33.15. So, despite some analyst downgrades and AI growing pains mentioned in the news, the company's financial health is strong. The current price being below its 52-week high also presents an interesting entry point.
Exactly. With their strong financials and strategic focus on AI with new advisors, I think Microsoft is well positioned. It looks like an upgrade from our last cautious buy rating. Our verdict for Microsoft MSFT is buy. Now let's turn our attention to Amazon, AMZN. The sentiment here was quite bullish, with people praising its competitive edge over traditional retailers, calling it an elite retailer. We've had a mixed bag with Amazon too, with a buy on November 4th, but stay away on October 28th and 30th.
Ethan, this is where the KPIs really challenge the sentiment. The user optimism is strong about their e-commerce dominance and AI investments, and yes, revenue growth is a solid 13.4, but that debt-to-equity ratio is an astonishing 43.405. I mean, 43.4? That's an extreme amount of leverage. This kind of debt for every dollar of equity presents a monumental risk that frankly overshadows even strong operational performance. It makes the company very vulnerable.
That's a fair point, Brooke. It's an unusual figure, to say the least.
Indeed. Given that extreme financial leverage, our verdict for Amazon AMZN is stay away. The risk is just too high to ignore.
All right, let's talk retail. Walmart, WMT. The sentiment was strongly bullish, especially in light of the affordability crisis hitting consumers. Users see WMT as a resilient player, calling it one of the only retailers worth caring about. We last rated WMT as stay away back on October 15th.
This is a fascinating turn. Walmart's revenue growth, while modest at 4.8%, is positive in a tough environment where competitors are struggling. And their ROE is strong at 23.3%. The market's high PE ratio for WMT, even for a retailer, suggests that stability and defensive qualities are being priced in. Their upcoming earnings report will be key, but strategically acquiring AI startups also shows a forward-thinking approach.
It certainly seems like the market sees Walmart gaining market share. It looks like a clear upgrade from our previous stay away. Our verdict for Walmart, WMT, is buy. Now let's turn our attention to Target, TGT. Unfortunately, the news here was not great, with a cut to their full-year EPS outlook and warnings about weak holiday demand. This is a new stock for our podcast, so this is our first official take.
And it's a tough one, Ethan. The stock is trading almost at its 52-week low, which tells you everything about market confidence. Revenue growth is actually negative at negative 0.9%, and that debt-to-equity ratio is a very concerning 132.309. Users are calling it a garbage company and comparing it to Kmart. Even the OpenAI partnership is being met with derision. Management's plan to ramp up capital expenditures with such a high debt load just amplifies the risk.
Yeah, it sounds like a company facing significant headwinds and a challenging path to recovery.
Absolutely. My verdict for Target TGT is stay away. There are just too many red flags right now.
And let's not forget Tesla, TSL. While there was chatter about a successful short-term puts trade, the overall sentiment and our past ratings lean heavily to stay away. The PE ratio is still astronomical at 278.61, and even with news about XAI fundraising, the company's beta of 1.872 highlights extreme volatility.
Exactly. That high PE combined with a modest 11.6% revenue growth and that high beta screams speculation rather than sound investment. Our verdict for Tesla TSL remains stay away.
So, to quickly recap our top candidates for deeper analysis today. Investigate as buy. Microsoft, MSFT. Walmart, WMT. Investigate as cautious buy. NVIDIA, NVDA. Investigate as speculative gamble. Amazon, AMZN.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
That's all the time we have for today's Daily Hunt for Multibaggers. Thank you for tuning in, and we'll catch you next time.
Brooke did our work.